Financial institutions play a pivotal role in the global economy, serving as intermediaries between individuals, businesses, and governments, facilitating the flow of money, credit, and investments. They are the backbone of economic growth and stability, providing essential services such as savings, loans, payment processing, and risk management. This comprehensive guide, Banking on Success, delves into the world of financial institutions, exploring their functions, types, and importance in today's complex financial landscape. Before starting, don't forget to like this video and subscribe to our channel for more videos like these. Types of financial institutions. Commercial banks. Commercial banks are the most recognizable and widely used financial institutions. They serve both individual and business customers, offering services such as savings accounts, checking accounts, loans, and mortgages. Commercial banks also play a crucial role in the creation of money through fractional reserve banking. Investment banks. Investment banks focus on raising capital for businesses and governments. They provide services like underwriting, mergers and acquisitions, M&A, advisory, and securities trading. Investment banks help companies go public by facilitating initial public offerings, IPOs, and provide expertise in complex financial transactions. Credit unions. Credit unions are member-owned financial cooperatives that offer similar services to commercial banks, such as savings accounts and loans. They are non-profit organizations, and their primary goal is to benefit their members by providing lower fees and better interest rates. Savings and Loan Associations, S&Ls. S&Ls specialize in providing home mortgage loans and savings accounts. Historically, they focused on home financing, but their services have expanded over the years to include other types of consumer loans. Mutual funds. Mutual funds pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other securities. They offer investors a way to access professional money management and diversify their holdings. Hedge funds. Hedge funds are investment funds that cater to high net worth individuals and institutional investors. They employ various strategies, including long and short positions, to generate returns. Hedge funds are known for their flexibility and ability to hedge against market downturns. Insurance companies. Insurance companies provide protection against various risks, including health, life, property, and liability. They collect premiums from policyholders and pay out claims when necessary. Insurance companies also invest their premiums to generate returns. Pension funds. Pension funds manage retirement savings on behalf of employees and retirees. They invest in a diversified portfolio to ensure there are sufficient funds to pay pension benefits to retirees. Central banks. Central banks, like the Federal Reserve in the United States, are responsible for regulating the money supply, setting interest rates, and maintaining overall economic stability. They act as lenders of last resort and play a critical role in influencing monetary policy. Functions of financial institutions. Financial intermediation. The primary function of financial institutions is to act as intermediaries between savers and borrowers. They accept deposits from individuals and institutions and then lend these funds to businesses and individuals in need of capital. Risk management. Financial institutions help individuals and businesses manage financial risks. This includes offering insurance products, derivatives, and risk assessment services to protect against unforeseen events. Payment processing. Financial institutions facilitate the movement of money through various payment systems, including checks, electronic funds transfers, EFT, wire transfers, and credit, debit card transactions. They ensure the smooth and secure transfer of funds between parties. Investment and wealth management. Many financial institutions provide investment and wealth management services. They help clients grow their wealth by investing in stocks, bonds, real estate, and other assets, all while considering the client's risk tolerance and financial goals. Capital raising. Investment banks and other financial institutions assist businesses and governments in raising capital through debt and equity offerings. They provide advisory services and connect issuers with investors. Money creation. Commercial banks have the unique ability to create money through the fractional reserve banking system. They can lend out more money than they actually have in deposits, which expands the money supply. Financial education. Many financial institutions offer educational resources and financial planning services to help individuals make informed decisions about their finances and investments. Importance of financial institutions. Economic growth. Financial institutions play a pivotal role in economic growth by channeling savings into productive investments. They provide the necessary capital for businesses to expand, innovate, and create jobs. Stability and confidence. A stable and well-regulated financial sector fosters confidence in the economy. Financial institutions help maintain stability by managing risks and providing liquidity during economic downturns. Wealth preservation and accumulation. Through various savings and investment products, financial institutions enable individuals and families to accumulate wealth over time and preserve it for future generations. Global trade and investment. International financial institutions, such as multinational banks and investment firms, facilitate cross-border trade and investment, contributing to global economic integration. Risk mitigation. Insurance companies and other risk management institutions protect individuals and businesses from unexpected financial losses, helping to mitigate the impact of accidents, disasters, and health crises. Monetary policy implementation. Central banks use financial institutions as conduits to implement monetary policy, such as controlling interest rates and managing inflation. Financial inclusion. Financial institutions can promote financial inclusion by providing access to banking services for underserved and marginalized populations, helping to reduce poverty and promote economic development. Challenges and risks in the financial industry. Market volatility. Financial institutions are exposed to market risks, including fluctuations in asset prices, interest rates, and currency exchange rates. These can impact their profitability and financial stability. Regulatory compliance. Stringent regulations and compliance requirements are imposed on financial institutions to ensure transparency, consumer protection, and financial stability. Meeting these regulations can be costly and complex. Cybersecurity threats. Financial institutions are prime targets for cyber attacks due to the sensitive information they hold. Data breaches and cyber threats can result in financial losses and damage to their reputation. Credit risk. Lending is a core function of many financial institutions, and assessing and managing credit risk is crucial. Economic downturns can lead to a rise in loan defaults, impacting the institution's financial health. Interest rate risk. Fluctuations in interest rates can affect the profitability of financial institutions, especially those heavily reliant on interest income. Liquidity risk. Financial institutions must maintain sufficient liquidity to meet their obligations. A sudden withdrawal of deposits or a shortage of short-term funding can pose liquidity challenges. Technological disruption. The rise of fintech companies and digital innovations is disrupting traditional financial institutions. Adapting to new technologies and competition can be a challenge. Future trends in financial institutions. Fintech and digital banking. Fintech, short for financial technology, refers to the innovative use of technology to deliver financial services. It encompasses a wide range of products and services, including mobile payments, peer-to-peer lending, robo-advisors, blockchain-based cryptocurrencies, and more. Fintech companies leverage data analytics, artificial intelligence, and other digital tools to enhance the efficiency, accessibility, and affordability of financial services. They often disrupt traditional banking models by offering convenient and customer-centric solutions. Digital banking, on the other hand, represents a subset of fintech that focuses on providing banking services exclusively through digital channels. This means customers can access their accounts, conduct transactions, and manage their finances entirely online or via mobile apps, without the need for physical bank branches. Digital banks offer features like easy account setup, round-the-clock availability, real-time transaction tracking, and personalized financial insights. They cater to the evolving preferences of tech-savvy consumers who seek a seamless and user-friendly banking experience. Blockchain and cryptocurrency. Blockchain is a decentralized and distributed ledger technology that records transactions across multiple computers in a secure and transparent manner. It ensures data integrity and eliminates the need for intermediaries, making it tamper-resistant and efficient for various applications beyond cryptocurrency. Cryptocurrency is a digital or virtual form of currency that uses cryptography for security. It operates on blockchain technology and enables secure and peer-to-peer transactions. Bitcoin, Ethereum, and other cryptocurrencies have gained popularity as alternatives to traditional fiat currencies, offering potential benefits like decentralization, fast cross-border transfers, and investment opportunities. However, they also come with regulatory and volatility challenges. Artificial intelligence, AI, and big data. Artificial intelligence, AI, refers to the development of computer systems that can perform tasks that typically require human intelligence. These tasks include understanding natural language, recognizing patterns, solving problems, and making decisions. AI technologies encompass machine learning, deep learning, natural language processing, and computer vision, among others. AI is used in various industries, from healthcare to finance, to automate processes, improve decision-making, and enhance user experiences. Big data refers to the massive volume of structured and unstructured data generated from various sources, including sensors, social media, and business transactions. Big data analytics involves processing and analyzing this vast amount of information to uncover insights, trends, and patterns. Organizations use big data to make data-driven decisions, optimize operations, and gain a competitive edge. AI plays a crucial role in big data analytics by automating data processing and enabling predictive and prescriptive analytics, turning data into valuable knowledge. Green finance and sustainable investing. Green finance is a financial approach that focuses on environmentally sustainable investments and projects. It seeks to allocate capital to initiatives that have positive environmental impacts, such as renewable energy, clean technology, and projects aimed at reducing carbon emissions. Green finance instruments include green bonds, green loans, and sustainable investment funds. The goal is to support the transition to a more sustainable and environmentally responsible economy. Sustainable investing, also known as socially responsible investing, SRI, or ESG, environmental, social, and governance investing, involves considering environmental, social, and governance factors when making investment decisions. Investors in sustainable funds or assets aim to generate financial returns while aligning their investments with their ethical or sustainability goals. This approach encourages responsible corporate behavior, social progress, and environmentally friendly practices in the companies and projects in which investments are made. Open banking. Open banking is a financial practice that allows third-party financial service providers to access and share customer banking data, with the customer's consent, through application programming interfaces, APIs. This initiative aims to increase competition, innovation, and transparency in the banking industry by enabling consumers to securely share their financial information with authorized providers, such as fintech companies and other banks. Open banking fosters the development of new financial products and services, including budgeting apps, payment solutions, and lending platforms, by leveraging the data from multiple banks. It empowers consumers with greater control over their financial data and fosters a more interconnected and customer-centric financial ecosystem. Regulatory frameworks, such as the Revised Payment Services Directive, PSD2, in Europe, have been instrumental in driving the adoption of open banking practices. Conclusion. Financial institutions are the cornerstone of modern economies, providing essential services that facilitate economic growth, risk management, and financial stability. This guide has explored the various types and functions of financial institutions, emphasizing their critical role in shaping the global financial landscape. As the financial industry continues to evolve in response to technological advancements and changing consumer preferences, financial institutions must adapt and innovate to remain competitive and serve the needs of a dynamic and interconnected world. What you think about our video, let us know in the comment section below. And don't forget to like this video and subscribe to our YouTube channel for more updates. Thanks for watching.